You ever had that feeling that the market is just messing with you, like personally? You see what looks like a clear trend, you jump in, and boom, it immediately reverses, leaving you holding the bag. It's a story every single trader knows. But what if I told you it's not just bad luck? It's about confusing chaos for a clear signal. So let's break that down.
I mean, this scenario right here, it's painfully familiar, isn't it? This isn't just about getting unlucky. It's the classic textbook mistake of confusing the market's random day-to-day noise with its real underlying signal. And believe me, this mistake is incredibly costly.
Take a look at this number, $358 billion. That's the estimated amount retail traders lost in 2024 alone. And a huge chunk of that, we're talking about 40%, it all came down to just bad timing. Getting in too late, getting out too early. See, the problem isn't a lack of information. It's the inability to see through all that chaos.
So that brings us to the big question. How do you find the real trend in all that mess? Well, that is the central puzzle we're going to solve today. And the answer is actually a pretty elegant tool that's designed to do one thing and do it brilliantly, filter out the chaos and show you what's really going on.
All right, section 1, smoothing out the chaos. So where do we even begin? Well, first, we've got to recognize what we're actually looking at when we pull up a chart. A raw price chart isn't a map. It's just pure, unfiltered noise. I mean, think about it. Second by second, you get this jagged, chaotic line that makes it almost impossible to see the bigger picture. Is the price going up? Is it going down? Sideways? Honestly, your eyes can easily trick you. And that's exactly where we bring in our tool.
A moving average is, well, it's beautifully simple. All it does is take the average price over a set period, let's say the last 20 days, and it plots that as a single, smooth, continuous line. It just soaks up all the random daily spikes and drops, the algorithmic glitches, the knee-jerk reactions to news, all of it.
And what's left behind? Clarity. That jagged, confusing mess transforms into a smooth, flowing line. Now, this line isn't trying to predict the future. No, its job is to reveal the present reality that was buried underneath all that noise. And that, right there, is the core power of a moving average.
Okay, but once you have the tool, you need to know which version of it to use, right? The type of moving average and the time frame you pick, they act like different analytical lenses. Each one shows you a slightly different picture of reality.
So the two most common types you'll hear about are the simple, or SMA, and the exponential, or EMA. Think of the SMA as your steady hand. It treats every single day in its period equally, which creates a very, very smooth line. The EMA, on the other hand, is more sensitive. It gives more mathematical weight to the most recent prices, so it reacts faster to new information. The trade-off is really simple. It's smoothness versus responsiveness.
Now, just as important is the time frame you choose. And here, the 50-day and the 200-day moving averages have basically reached legendary status. The 50-day is kind of like the swing trader's guide. It shows you the intermediate trend over about 10 weeks. But the 200-day? Oh, that's the big one. It's considered the benchmark for the market's long-term health, and it's watched by literally everyone, from tiny retail traders to the biggest funds on Wall Street.
Okay, so we've got our smoothed out lines. How in the world do we turn them into actual actionable signals? Well, there are two main ways that traders read these lines to make decisions. So first up is the most famous strategy of them all, the crossover. You've probably heard of the golden cross. This is when the faster 50-day average moves up and literally crosses over the slower 200-day average. It's widely seen as this powerful confirmation that a new long-term bull market might just be starting. It's simple, it's visual, and it gets rid of all that subjective guesswork.
But, and this is a really important but, we need some context here, a reality check. If you look at over 70 years of data for the S&P 500, the Golden Cross was followed by positive returns a year later about 68% of the time. Now that sounds pretty good, right? But just buying and holding the index over any random one-year period had a win rate of 74%. So what's the takeaway? The Golden Cross can be great for helping you sidestep major bear markets, but it is not some foolproof system for outperformance.
The second key way to use these is as dynamic levels of support and resistance. And this is fascinating because millions of traders are all watching the exact same lines, they become self-fulfilling prophecies. So in a strong uptrend, traders see the price dip down to the 50-day moving average, and they all think, aha, this is my chance to buy the dip. And their collective buying creates actual support right on that line. It's psychology in action.
All right, finally, let's talk about avoiding the common traps. Because knowing how to use these tools is only half the battle. Knowing how not to use them is arguably just as important. Let's cover the most common mistakes that trip traders up all the time.
These are the big four. You've got time frame mismatch. That's like using a 200-period average on a 5-minute chart and thinking it shows you the long-term trend. It doesn't. Then there's ignoring context. That's trying to use a trend-following strategy when the market is just chopping back and forth with no direction. Curve fitting is a classic. You find some perfect magic setting that worked amazingly on old data, but it fails the second you use it in the live market. And of course, the emotional override. The system gives you a clear signal, but you ignore it because of fear or greed.
So if you take one thing away from this, let it be this. Moving averages are not a crystal ball. They are a lens. Their one and only job is to help you see the current market environment with more clarity. They filter out the distracting noise so you can make smarter decisions based on the underlying trend.
So now, with this framework, you can look at any chart and ask that exact question, but with a whole new perspective. Instead of just seeing chaotic price zipping around, you can apply a moving average, smooth out the noise, and start looking for the real signal. So, what is the trend telling you today?